Hello everyone, welcome back to All Financial Discussion channel. For this video, I like to discuss how can we actually make use of CPF in order for us to plan our retirement plan. So in short, I'm going to explain what is actually OA, SA, RA, and MA roles when we actually plan for our retirement. So this will be the objective of this video. Let me explain the three basic needs in our retirement plan. The most important, in fact, will be a fully paid up home. This is because we can forget about rental if our home is fully paid up. Next, insurance and also some saving for our healthcare. This is because in Singapore, the cost of healthcare in fact increase in an exponential manner. So typically, we need to have some form of insurance and some saving in order for us to cover our healthcare in our elderly age. Next, a steady stream of lifelong retirement income. This is also very important. We need to have a passive income for us to retire comfortably in Singapore. So these are the three basic needs in order for us to retire comfortably in Singapore. Let's come to the first basic need. Owning a home means you don't have to worry about rent. Strike a balance and buy a property within your means. I must say that I actually disagree with these sentences. I will explain later on. Your CPF saving eventually form your retirement income. So every dollar you spend on housing could be a dollar less for your retirement needs. For me, this is my suggestion. When you are actually so-called young, try to buy a bigger property like 5-bedroom property or 4-bedroom property. So when you actually ages, when you are about to retire, you can sell this bigger property to buy a smaller property like 2-bedroom or 3-bedroom with the income that you actually generate. Okay, so this can be a form of your retirement fund. So this is my suggestion. Buy a bigger property when you are actually young, sell the bigger property and buy a smaller property. The income that you actually generate can be a source of your retirement fund. Next, this is where your MediSave saving come in. Okay, think of it as your healthcare saving actually account. It actually help you to set aside part of your income for medical expenditure such as hospitalizations and outpatient treatment. So this is like a forced saving when it is your rainy season. Okay, for example, you are required, touch wood, to be hospitalization. This form of income can actually help you out. You can also use MediSave to cover premiums for MediShield Life and other approved medical and long-term care insurance. Let me come to the third needs in our retirement. While we know how much we have saved, we can't predict how long each of us will actually live. Okay, so therefore, we actually have this CPF Life. Okay, so this CPF Life will allow us to get a money payout no matter how long we actually live, so that we can actually enjoy this CPF saving with greater peace of mind. So this is in fact the three basic needs for our retirement. This diagram here show that our CPF is made up of OA, SA, RA, and MA. Okay, so when we actually start with CPF account, we actually has OA, SA, and MA. After we reach the age of 55, then we actually has this RA. So this is what it means here. When we actually start to work and we meet CPF contribution, in fact, we will accumulate the saving in these three accounts: OA, ordinary account; MA, MediSave account; and SA, special account. Once we reach 55, okay, the RA account will be created and your SA account will be closed. So this is our CPF account. How much we actually contribute to our CPF is in fact depend on our ages. This table here, okay, so for example, when we are actually at 55 years old and below, okay, so let's see the contribution of CPF. Beside the salary, okay, we receive a salary, and addition, we actually receive 17% contribute to our CPF by our employer. Next, we also contribute 20% of our salary. For example, we have $1,000, $200 will be contribute to the CPF by us as an employee. So in total, okay, we actually has 37% of our salary contribute to our CPF. Okay, so basically the rest will be the same, I guess you can interpret. But one thing that I like to highlight, when we actually getting older, you can see from here, when we actually getting older, you can see that both our contribution and also our employer contribution actually start to decrease, as you can see from here. So from here, you can see that when we are actually younger, more money actually contribute to CPF. When we are actually getting older, lesser will be contribute to the CPF, as you can see from here. So this is our contribution to our CPF, which is actually depend on our age. This table here show our CPF allocation rate, okay, for OA, SA, and also RA once we reach the age of 55, and also MA. Okay, so I don't want to explain in deep detail, but how the CPF actually contribute to the three different pockets is shown over here. But as you can see from here, when we are actually younger, majority actually park into OA so that we can have enough money to buy our property, for example here. So some will actually go to SA, and quite a small amount actually go to MA when we are actually much younger. So from here, you can see that when we actually getting older, you can see that the contribution to OA also reduce. You can see from here the SA, or maybe once you reach the retirement age, okay, you become a RA account. Okay, so from here you can see that when we actually getting older, more actually come into SA rather than OA, as you can see from here. And once we actually about to retire, which is 55 years old, you can see that our SA actually convert into RA, and the amount to contribute to RA start to so-called firstly reduce, and then after increase, after that reduce again. Okay, so but for MA, it is quite obvious. Once we getting older, definitely we need to have more medical care when we actually are older. So therefore, from here you can see that our MA account actually allocate a bigger share when we are actually older. So this is on our CPF allocation rates. Coming to the interest rate of OA, SA, MA, and also RA. Okay, so from here you can see that OA typically has the lowest interest rate, 2.5% per annum, while the rest, SA, MA, and RA, they basically guarantee an interest rate of 4% per annum. This is in fact very safe investment because this interest rate is backed up by our Singapore government. So therefore, this is actually considered a very safe haven for us to invest by generate some so-called quite a fair bit of interest rate. So this is on the interest rate of OA, SA, MA, and RA. Next topic, how to save more and earn interest from CPF. Okay, so basically the keyword will be compound interest. Okay, so for example, for me, in fact, I work at a very young age, around 16 years old for part-time. And basically with compound interest, okay, so when I actually buy a flat, I don't have a big issue. So therefore, this is the attractiveness of earning an income in CPF, which I'm going to explain. So if you are below 55 years old, okay, so let's say that you set $1 to your SA account from your employment. Okay, so in fact, your employer will chip in another 0.85, which means that total at the SA, you have 1.85. Let's take a look on the compound interest. Okay, so this 1.85 without doing anything, they will double to 3.7 in about 18 years. And in fact, they will be at 7.3, okay, in about 35 years. So imagine this. This is about 7 times more than what you actually contribute earlier on. So basically, this is the attractiveness of compound interest. So please take note that this is all compute using the basic interest of 4% per annum on your SA account. A quick disclaimer, this is not a financial advice. Please conduct your own independent research and consult a professional if needed. Never invest more than you're willing to lose. With this, we are ready to kickstart today's discussion. But before that, I'd like to urge you guys to help me by like this video. Guys, if you have learned something from this video, urge you to help me by like this video. Guys, it's free. Help me. Press the like button now. For those who are new to this channel, and if you want to support me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. Next will be top up your CPF. There are in fact two forms. One is to make cash top-ups. Another one will be a top-up with a mix of cash and CPF saving. You probably will ask, why bother to top up? So when you actually top up, for example, okay, for certain scheme, the government will match your top-up, which means that let's say you contribute $1,000, the government will also contribute $1,000. Okay, so basically this is the attractiveness of doing top-up. I will discuss a little bit more later on. Okay, but this is the key attractiveness of doing a top-up. Another attractiveness of doing top-up, this probably can be a tax rebate. Okay, so let's go a little bit in depth on cash top-up. Okay, so whether you are an employee or in fact you can be self-employed, okay, you can grow your saving by making cash top-up to either OA, SA, and MA, okay, which means that all the three accounts, you can't just top up onto OA. You need to top up onto the three accounts, OA, SA, and MA, or if not, you can top up only to your MA. Okay, so by making cash top up, you can earn interest even when you are not working or do not have a regular CPF contribution. For those who are actually self-employed, okay, so most of the time, they probably will do some form of top-up. They will have some money in the CPF, which can earn quite a fair bit of interest. Even when they actually retire, they can still have some form of attractiveness of CPF. Next, top up with a mix of cash and CPF saving. If you would like to save specifically for retirement, okay, so this is mainly for retirement, okay, you can top up your SA or RA using cash or CPF saving. Okay, so this is for top up. Let's come into more detail in terms of the scheme of top up. Let's come to the first scene of top up, okay, which is MRSS, Match Retirement Savings Scheme. Okay, so for example, if you are 55 years old or in fact older and you have yet to meet the current basic retirement sum, BRS, okay, so don't worry what is BRS, basic retirement sum. On my next few video, I will explain this. This is, for example, okay, you didn't meet the criteria of this basic retirement sum in order to enjoy the CPF Life, for example, for this case here, then you can do a cash top-up. When you actually do a cash top-up, you probably can meet the basic retirement sum. This, in fact, can guarantee a higher retirement payout. So why people actually top up? This is because the Singapore government will match every dollar of your cash top-up that is actually met to your RA, okay, up to a maximum of $2,000 a year from 2025 with a 20,000 cap over your lifetime. Okay, imagine this, you receive $20,000 from your government. How attractive. So therefore, this is quite attractive. When you are not able to meet your basic retirement sum, you can actually do a cash top-up. let me explain how to use your OA account. Okay, so many members actually use CPF OA account to buy a property or serve a housing loan. Okay, so this is in fact the key purpose of OA. Like I mentioned earlier on, when you are actually younger, more actually will go into OA. In fact, this OA can use to buy a property, or in fact also later on, you can also serve your housing loan. Important thing to note, okay, so while you may use your OA saving to pay for your property, consider keeping some saving. Okay, so for me, okay, this is for so-called in case that you have some form of unforeseen event. So therefore, I also suggest that you keep some into your OA. So any unusual event, you still have some to pay your housing loan. For example, for this case here. Okay, so this saving can help with future mortgage payment in times of emergency. If left unused, this saving can also grow at a stable interest rate, which is 2.5%. Next, using your MA saving. Okay, so this MA saving, in fact, will be able to use, for example, touch wood, when you actually in hospitalization and for some approved medical insurance. MediSave is a national savings scheme which helps CPF members save for medical expenditure, especially after retirement. So basically, when you actually retire, this can be your bulk, so-called in terms of taking care of your health care. You can use your MediSave saving for your own and also for your dependents, hospitalization, day surgeon, and certain outpatient expenditure. The payment of premium for insurance coverage. You can also use your MA case to pay for the yearly premium on approved insurance plan. For example, your Shield, your Care Shield, your MediShield, and other medical insurance that offer additional benefit on top of those that actually provide by MediShield Life. I'm going to explain how to use your RA saving. In fact, mainly for retirement withdrawals. Okay, so from age 55 years old, okay, in fact, you have the flexibility to withdraw your CPF saving after you actually set aside the minimum retirement sum in your RA. Okay, so simply means that if you are able to so-called surplus as compared to your minimum retirement sum, you have the flexibility to withdraw the money out. In fact, you can withdraw at any time, okay, whether in full or partial, and also as frequently as you actually like. So some important thing to note, okay, so you do not have to withdraw all your withdrawable saving at one go. Okay, what does this mean? Which means that after you reach 55 years old, and in fact, if you meet the minimum retirement sum, you don't need to withdraw the surplus at one go. So therefore, if you do not have an immediate need, you may find it better to leave your savings in your CPF account in order for you to earn interest rate up to 6% per annum. Okay, probably I must say that 4% per annum is guaranteed. 6% you need to meet certain requirement. So basically keep this in mind. If you withdraw, okay, you can't put it back into your RA. So therefore, please be very careful. If you don't have any need, okay, in fact, this saving investment can be quite useful because imagine this, the interest is actually guaranteed by Singapore government, and this is probably one of the safest way to invest with a guarantee of 4% per annum. Next, the money payout for as long as you live. Okay, so after age 65, okay, you can actually apply to start receiving lifelong money payout under the CPF Life. Okay, so you will use your RA saving, okay, to join your CPF Life. Okay, so basically, this is what I mean earlier on the minimum retirement sum. Okay, so basically they will park under the RA, and this RA saving will allow you to join your CPF Life. Okay, so this CPF Life allow you to receive a money payout as long as you live. Okay, basically this is what I have for you for the quick introduction on CPF. If you have learned something from this video, help me to like this video and subscribe to this channel. Once again, thank you so much for your strong support. I hope to see you guys soon. Bye for now. Thank you so much.